Hello, everyone. Welcome to the weekly lecture videos. This week, our topic is some lessons from capital market and also risk and returns. And we are covering two chapters this week, chapter 10 and chapter 11. These two chapters take us into a new territory, the relationship between risk and return. As you will see, this chapter has a lot of practical information of anyone thinking of investing in financial assets such as shares and bonds. This chapter gives you an idea what to expect when you invest, and also shows how risky a certain investment can be. And it gives you the tools to think about risk in an objective way. Thus far, we have not much to say about what determines the required rate of return on investment. In the previous two chapters, we have used the required rate of return to evaluate an investment, but we didn't learn much about what determines that. In one sense, it's very simple. The required rate of return depends on risk of the investment. The greater the risk, the greater is the required return. Having said this, we are left with a somewhat more difficult problem. How can we measure the amount of risk present in an investment? And put another way, what does it mean to say that one investment is riskier than another? Obviously, we need to define what we mean by risk if we are going to answer this question. This is our task in the last two chapters. So let's start with chapter 10. And as usual, we have several learning objectives. We will mostly learn about how to calculate return on investment, historical return. We will learn about the risk of an investment. And towards the end of this chapter, we will learn the concept of market efficiency and its implication. So in this video, I will be concentrating on how to calculate return on an investment. Look, first of all, when we say return, the return can be dollar returns or return can be percentage returns. If you buy an asset of any sort, you gain or loss from that investment is called your return on investment, right? Now, the return will have two components. First, you may receive some cash directly while you own the investment. This is called income component of your return. And second, the value of the asset you purchase will often change. Okay, in that case, you will have a capital gain or capital loss. Okay, if you remember previously, we have learned how we calculate return. I mean, value of a bond, value of a share, and we have seen that it depends on, for example, for a share, it depends on how much dividend you receive, and also what is the selling price. Okay, so similarly, when you calculate return, these two components come into play. So you can see here that total dollar return is the return on an investment measured in dollars. So it should be dividend plus capital gains. And capital gain is when you sell your investment higher at a price higher than your initial investment. And if your sell price is less than your initial investment or your purchase price, then you have a capital loss. Okay, so that is your dollar return, dividend plus capital gains. Percentage return, on the other hand, is calculated this way. So instead of dividend, you can see that instead of dividend and capital gain, we call it dividend yield and capital gain yield. So essentially, dividend yield is the rate of return, I mean the percentage return from dividend, and capital gain yield is percentage return from capital gain, and that combinedly makes up percentage return. Okay, so a dividend yield essentially is the dividend divided by your investment, that is price, and capital gain yield is the price differential, that means your selling price and purchase price divided by, once again, your investment. So the total percentage return is dividend, for example, the interim cash flow that you receive from the investment, then price differential divided by PT, the price, which is the beginning price, and you get your percentage return. Okay, so look at this example. Now, let's say that you buy a share for $25, and after 1 year, your share price is $35. And during your holding of the investment, you get a $2 dividend. Okay, so what is your dollar return? You get $2 dividend, and your capital gain is $10, right? Because your selling price is 35 and your purchase price is 25. So your capital gain is $10. So your dollar return is $12. 2 plus 10, $12. And percentage return is, as I already said, that you will divide each component of your return by your purchase price. So $2 dividend divided by 25, which is your purchase price, $10 capital gain divided by 25. So 12 divided by 25, and your percentage return is 48%, you can see. Okay, so in terms of dollar, your return is 12%, $12. And in terms of percentage, when you compare your dollar return with your investment, value of your investment, then you get the percentage return. Okay, so this diagram essentially tells you how we calculate the return that we have just discussed, right? So you can see that at the beginning of the year, which is at 0 time, you make this investment, $25, okay? And you hold it for a particular time period, okay? Particular time period, and you get a dividend of $2, okay? And at the end of the year, you sell, ending selling price at year 1, ending selling price is 35. Okay, so these are your return component, $2 dividend, and the difference between your sale price and purchase price. Okay, we have already explained how we calculate the returns. Now, let's talk about historical average return, risk-free rate, and risk premium. The example that we have seen in the previous slide was an investment that was held for 1 period, right? So 1 year. So we had 1 return. Now, it might be possible that an investment is held for several periods, several years, and we may be interested to calculate an average rate of return over the period. Okay. Now, average rate of return is very simple to calculate. Okay, so we will have periodic return, and if we want to calculate average return, we will simply add up and divide by the number of observation or number of periods. Okay, so for example, if we hold an investment for 10 years, we have yearly return. We will just sum up all these yearly returns and divide it by 10. So we get an average yearly return. Okay, this is called arithmetic average. We will discuss it. We will discuss it a bit more detail. So if you look at this example, average annual return from 1993 to 2018 for All Ordinaries Index, that's a benchmark index of Australian Stock Exchange and government bonds cash inflation. So you can see that these are the annual average return from 1993 to 2018. So the way that was calculated, as I just mentioned, that annual return, all annual returns are added up and divided by the number of years or number of observation. So we get an average return and we get a feel that what is the overall return from these investment for a particular time period. Okay. The next we are going to talk about the risk premium, but to understand the risk premium, let's understand the concept of risk-free rate. Risk-free rate is the rate of return on a riskless investment. Okay, so typically we understand that all investment is associated with some degree of risk, but we are referring to default risk in this case. Default risk means the possibility that the issuer of a security might fail to pay interest and principal. Okay, and now government securities are typically called free of default risk because government are unlikely to default. Okay, so government securities, for example, treasury bonds or treasury bills, these are the best example of risk-free investment, and the rate of return provided by those government securities are risk-free rate. Okay, and these are called risk-free rate, as I already mentioned, because these are the returns we get by investing theoretically in a risk-free investment. And the next point is risk premium. Now, look, since we have so far computed or so far seen some average returns, it seems logical to see how they compare with one another. Okay, so based on our discussion so far, you see that comparison could be done between investment in equities, government securities, cash, and so on. Okay. The example that I just showed here, this cash is can be considered as risk-free, as I was saying, that this is a risk-free rate of return because that's essentially is the return we get from investing in a virtually risk-free investment. Now, one particular interesting comparison involves the virtually risk-free return on investment and very risky return on investment. Okay, so you can see that the rate of return in almost a risk-free investment is 4.82, and the rate of return from a very risky investment, which is all ordinary index, is 10.24. So essentially, the difference is about 6%. Okay, now about 6% return is called risk premium. Okay, this is called risk premium because this is essentially is an excess return for additional risk that we get for investing in this risky investment. Okay, so if you invest in a risk-free investment, let's say you get 4% return, and you invest in a risky investment and you get 10%, the difference between this risk-free rate of return and risky rate of return is called risk premium. Okay, risk premium, and this is essentially is the excess return for investing in risky security, and you also can say it's a compensation for taking a risk, compensation for investing in a risky security. And these are average return and risk premium. So you can see that risk premium for this risky investment is 0 because you don't get any premium. It's virtually risk-free. Government bonds provided 1.48, and all ordinaries index had a risk premium of 5.42. Now, look, I just gave government bonds as an example of a risk-free securities, but as I said, that government bonds are free of default risk. Sometimes government bonds may involve some other risk, for example, interest rate risk. And also government bonds can be a federal government bond, municipal bond, or state bonds. Federal government bonds are free of default risk. However, local government bonds, for example, municipal bonds, can be associated with some degree of default risk. Okay. Now let's talk a little more about the rate of return. Okay. Um, thus far we have looked at simple average return. Okay. So we said that average return is simply summing up the periodic return and divide by the number of observation. So that is called arithmetic average. Okay, but essentially there are two ways to calculate average. One is the arithmetic average, another is geometric average. Okay, so the simple average that we have discussed so far is an arithmetic average. Okay, so you can see that arithmetic average is calculated as the sum of all individual return divided by number of observation. Okay, so this is arithmetic average. There is another way to calculate average. This is called geometric average. So in geometric average, we essentially calculate the compound return per period over multiple periods. Okay, over multiple periods, and you can see that how we calculate this. These are the periodic return components. Okay, so 1 plus the return component, we multiply them, and then we take a power of 1 by t. T is the number of periods. Okay. So this is one problem that is showing how you can calculate geometric average. Now you can have a question in your mind that, okay, we know the simple average. Simple average is arithmetic average. So why do we need geometric average, or why do we need geometric mean? Okay. Look, when we concentrate on historical returns, the difference between the geometric and arithmetic average return is not too hard to understand. To put it slightly differently, the geometric average tells you what you actually earn per year on an average compounded, okay, maybe quarterly or so. The arithmetic average tells you what you earned in a typical year. Okay, so you should use whichever one answers the question you want answered. Okay, so I repeat that, for example, you have a rate of return, yearly rate of return, but that was compounded semi-annually or quarterly. Okay, then a geometric average will tell you that quarterly compounding, what is your typical return, average return on a year. Okay. On the other hand, the arithmetic average will simply tell you the typical rate of return in a year. A somewhat trickier question concerns which average return to use when forecasting future wealth levels. And there is a lot of confusion on this point among analysts and financial planners. Okay. First, let us get one thing straight. If you know the true arithmetic average return, then this is what you should use in your forecast. Okay, so for example, if you know the arithmetic return is 10%, then your best guess for the value of a $1,000 investment in 10 year is its future value, 1,000, 10%, 10 year, which should be, for example, 2,500 or so. Okay. The problem we face, however, is that we usually have only estimates of the arithmetic and geometric returns, and estimations have errors. We learned it in the previous weeks. In this case, the arithmetic average return is probably too high for longer period, and geometric average is probably too low for shorter periods. So you should regard long-run projected wealth levels calculated using arithmetic averages as optimistic, and short-term projected wealth levels calculated using geometric averages are probably pessimistic. Okay. As a practical matter, if you are using average calculated over a long period of time to forecast up to a decade or so into the future, then you should use arithmetic average. Okay. If you are forecasting a few decades in the future, okay, then you should just split the difference between the arithmetic and geometric average returns. Finally, if for some reason you are doing very long forecast covering many decades, then use geometric average. Okay. So this concludes our discussion in this video. So in the next video, we will talk about how to estimate risk. Okay. Uh, okay. So thank you very much.